Hey, good morning, everyone. Marty Mazzora here. It is Thursday, the 19th of December, 2024. Second video in 2 days, because the one I shot for you yesterday was at about 8:30 Pacific time in the morning before all the fireworks started. We did talk about the prospects for the Fed meeting. It came off precisely how I suggested it would and gave you the reasoning for that yesterday, and that was quarter of a point rate cut, but very hawkish language about what they're going to do going forward. And I did suggest it could get dicey. Maybe that was an understatement. It had to be one of the biggest down days of the year, I'm sure. And ironically, a quarter point cut in rates, much like the 50 basis point cut in September, resulted in markedly higher interest rates. Counterintuitive to a lot of people. I found myself explaining that several times yesterday, which is very understandable. How is it that the Fed can cut rates and interest rates go up? Well, interest rates on short-term debt or short-term loans that banks control, because when they cut the Fed funds rate, they cut the cost of money for the banks. That can get passed on, should get passed on, to say auto loans and credit card loans. Mortgage loans, however, for example, are going to be tied very closely to the bond market, specifically Treasury bond. And so a market-based interest rate, like mortgage rates, and of course mortgage-backed securities and things are behind that as well, they're going to be determined by the economic outlook. So if the Fed cuts interest rates into what has been reasonably strong economic data, the market could very easily surmise that this is an inflationary rate cut. Therefore, interest rates should go up. And that's what I warned a few people about who were eagerly anticipating the half a point cut previously. I said, in this environment, be careful what you ask for. And that's exactly what happened. So the market fears rekindling inflation next year. And you can see what it did to the stock market that has really been living on Fed life support, if you will. So this morning, what I thought I would do is actually just look at the exact same screens we looked at yesterday, look at where they are this morning, and talk about what's changed, or is this morning's rally anything worth getting excited about, and so forth, using the same sort of context or logic that we used yesterday. So the first screen in front of you is the first screen that was in front of you yesterday, and that's the Bloomberg IMAP screen, which takes, in this case, the S&P 500 sector by sector. And as you can see right now, the S&P 500 is up 0.29% on the morning. It was up a lot more than that at the open. There was definitely some dip buying. But more than half of the stocks are down. You can see that just 47% are actually in the green. This is that dismal breadth that I talked about yesterday that has really been showing up again of late. So you've got, communication services having a nice morning, utilities bouncing back, which is very interesting. Financials having a nice rally this morning. Tech's coming back, nice. It got creamed yesterday. Consumer discretionary as well, but industrials, consumer staples, energy, real estate, materials, and healthcare are really getting walloped again today, particularly healthcare. Now, while I'm thinking about that, because we have notable positions in consumer staples and healthcare, which is part of our defensive posture right here. So yesterday, just our core allocation. So if you have a retirement plan and you're allocated exactly to our core, speaking to your clients, of course, your portfolio went down roughly 1.5% yesterday, which had to be our biggest down day of the year, no doubt. Little less than that, probably 1.4%. So the S&P went down 2.95%, call it 3%. The Dow was down, I believe it was around 3%. The NASDAQ was down about 4%. We're going to see the evidence of that here in a second. So the core portfolio, which we have been managing to a moderate to somewhat conservative theme this year for all the reasons that I've been continuing to express on the blog. It captured half of the market move. Now, that sounds great and that sounds conservative, but the move was dramatic to the downside. The last notable down day where the NASDAQ was down 2% and the S&P was down 1%, we were down about 0.25%, maybe 0.2%. So the portfolio is kind of doing what it's supposed to do right now. The way we're managing it is capture some of the upside, but focus on the potential downside, and that's due to all the stuff that I've been talking about for months and months now. But then you wake up today and you think, okay, well, the market's rallying a little bit, but it's quickly giving back that rally. The Dow is up 300 points. It's now up 125 points. The S&P is now up about 0.25%. But the S&P equal weight is down 0.18%. Right now, our core allocation is down about that, 0.17%, due to its just massive diversification. Another thing that was very helpful yesterday were the S&P 500 put options. They mitigated about 0.45% of the decline. So without hedging right here, we would have had a pretty good chunk lower. And then the rest of it was just, our 26% position in short-term treasuries and that sort of thing, which kind of buffered a little bit. But gold certainly didn't help. Gold was down, well over 2%. Now, we did recently put a hedge on our gold position. So that mitigated, about a fourth to a third of that decline in gold. Gold's off about 0.1%. Gold can get very, very volatile, and it is a not small position for us, which has been good this year. It's still up. It's got to be 25% year to date. It's just not going to correlate with the stock market. We actually did have something up, and that was our ag commodities positions and or position. We have it wrapped up into an ETF. So it was actually positive by about 0.5%. It's down 1% today. So as I continue to reiterate directly to your clients, and I did it yesterday on the video, is we don't manage a stock portfolio. So if you're watching your stuff every day and you're watching the market, you're going to see some days where you think you should be rocking and rolling because the market is, and you're not. You're going to see days where you think you should be crashing because the market is, and you're not. You're going to see days where the market's down and you think you'll be down and you're up, because what we're doing, folks, is we are diversifying and, I'm going to say, taking advantage of all asset classes across the globe. Lots of deep research that goes into it. We're going to have some coverage in lots of different things in lots of different parts of the world. Speaking of parts of the world, yesterday, the rest of the world pretty much took that hit with the U.S. Today, we're getting a little bit of relief, although we've given a lot of that back. Our Asia-Pacific developed markets exposure is up just barely, call it flat on the day. Our emerging markets exposure is up pretty nicely. I would say a little better than 0.5% across the board. So that's outperforming the U.S. As I mentioned, financials are doing good, but we do have a modest position in long-term treasuries. That's getting creamed again this morning, down 1.5%. That's a response to the potential for rising interest rates. I'm going to speak a little bit about those prospects here in a minute. Energy is down about 0.33%, and so on. But you can see that, actually. You can see that here as well. Okay, so market up a little bit. More than half the stocks in the S&P are down. The Dow, a little better breadth. I guess 2 to 1, positive or negative. Right now, 21 are up, 9 are down, with the Dow up 100 and something points. I talked about the sell signals in the MACD yesterday. We don't need to get into that. NASDAQ is up a bit this morning, but there are more down stocks than up. So bottom line here, folks, is the stock market is down a lot in December, even though the headline indexes may not show that as much. For example, yesterday when we were looking at this chart, the purple line was the NASDAQ Composite Index, or the ETF that tracks it, was up 4%, a little better than 4%. Today, it's coming up a little bit, 0.4%. This is all of December's gains right here. The S&P was positive as well. It's down 2.5% now. NASDAQ 100, same index, but the stocks are equal weighted, not concentrated in the biggest stocks, is down 5%. You can see it's down this morning. And then here's the equal weight down 6.65 plus another 20 basis points. So it's a 7% decline for the U.S. stock market in the month of December. So again, folks, if you don't have your whole portfolio really focused or concentrated in the Magnificent Seven or the index or indexes, the purple line and the white line that are so overweighted there, which is a problem that I expressed yesterday and I've expressed a lot on the blog, you would be crazy to have your concentration there, in my view, or very, very, very risky. But ironically, if you're being, so to speak, safer and broadly diversified and so forth, you're actually doing worse at the moment. And that's the short-term dynamics of the market, which is why we are not short-term investors. We do what we think makes good long-term fundamental sense, looking through cycles, not even months and years, but actually market cycles or economic cycles. Okay, so on the right feature, the dollar and international stocks. The dollar is up 1.5% in December. That's a problem. I'll show you the chart again in a second of the dollar. The long-term treasuries are now down 5% just in December. People who think there's safety in bonds are getting quite the awakening here, as they have the past 2 or 3 years. I mentioned the S&P is now down about 3%. Little better action in the MSCI All-World ex-US and in the Europe, Australasia, and Far East Index. That breadth, remember we were about 38% of the stocks were trading below their 50-day moving average in the S&P 500 while the S&P was still above it. Now it's just really, really low. So this speaks to the risk that I showed you in this chart, which literally came to fruition a few hours after I published that video here. The S&P is now trading all of a sudden below its 50-day moving average, and I'll look at that here in a second. And then this one, just because we pulled it up yesterday, you can see that breadth, advanced decline, turn back over. Don't need to relive this one, but this is a long-term chart that says the NASDAQ is way, way out over its skis right here with all that concentration. Okay, as for the technicals, as I just mentioned, so here is the S&P 500 with a massive down candle breaking through that resistance that I suggested a week ago that looked like it was going to, because the way it was pounding against it. And then I said, the next, you'll either buy the 50-day moving average, or if it breaks through, you might want to short some more if you're trading it that way. So you can see this morning at the open, it tried to break back above it. So if it fails at the 50-day moving average and trades lower toward the end of the day, which it may very well based on what I'm seeing, I'm not making a prediction, but it wouldn't surprise me, that would be a very negative technical signal right there on the daily chart. You can see the MACD rolling over and so forth. Tomorrow is a massive options expiration date. I really don't know how that's going to play out in the market. Leading up to it, the options experts who we leverage for their expertise, we're pretty bullish on it. They become much less sanguine than they were. So we'll see. It could be a big day. That could be a washout. Could be worse. Then we could get into next week and get that Santa Claus rally underway. And like I said, folks, and I actually intimated that it could get ugly as early as January. Well, it got ugly yesterday. I did say that I do think the next big ugly patch will probably get bought. We'll probably see some dip buying. It wouldn't surprise me to see it get notably worse before it gets notably better, but it wouldn't surprise me to see new all-time highs early next year. I'm not making that prediction. I'm just telling you what wouldn't surprise me, right? Ultimately, though, I think next year can get pretty ugly. But like I said yesterday, ugly markets aren't bad things. If you are properly allocated going in, your stuff's going to get ugly too, not as ugly as everything else. And then there are opportunities always, this time won't be different, to take advantage of amid all that ugliness. So the NASDAQ daily chart, we just rolled over into a pretty compelling sell signal on the MACD. We're more interested in the MACD trends and divergences, but right now this is your textbook sell signal. Fell right down onto the uptrend line. If that holds, that's bullish right now. If it holds this 20-day moving average, which is the yellow line, that would be bullish as well. Right now, the jury is definitely out on that. As for the dollar, I said the higher it goes, the more problematic it becomes. Yesterday was a vivid example of that. And I remember I said if we get back to this point, we're going to have quite the bearish divergence. The technicals say that odds favor the dollar coming back down over the, say, the next week or three. That would probably be pretty bullish for stocks, so we'll watch for that. Gold got walloped. Gold's troubling me here in the short term. As I mentioned, we're very bullish long term. I'll offer some of that up in part 3 of the year-end letter, which will come within the next week, 2 weeks tops. So because we were troubled by it, and a lot of it is technical, we are hedging it, so we can't get hurt too bad. But long term, I think gold is something that's going to be a fixture in a smart, well-diversified portfolio. I just added one chart for today, and that is the 10-year yield chart. Again, shooting back up again against that 4.5. I don't think I showed this yesterday, but I think I did articulate that 4.5% is that problem zone, or it has been for stocks, and we're at 4.56 this morning, and the stock market has been struggling when we get at 4.5 or above, and it is definitely struggling to hold on to its gain. The equal weight is still down a little bit. Rest of the world's down. Staples are still down. Healthcare is having a pretty ugly day today. So these are all stocks we own. So anyway, we'll see how yields go. So the Fed and their stated expectations are that inflation's going to be a bit hotter next year than they anticipated. Therefore, don't expect nearly the rate cuts that the market had been expecting up till now. And that's essentially what I said to expect yesterday. So again, with my notes, the only thing I added yesterday was another note from Nick Timiraos, the gentleman who the Fed leaks information to, literally, or at least implores him to pen articles to kind of give the market a heads up. He clearly did that. It was easy to anticipate yesterday's based on this, but obviously the market might have been thinking something differently the way it reacted to precisely what I said it was going to do yesterday in terms of the Fed rate cut and what their language is going to be. So now, after the meeting yesterday, the Fed assessment of the balance of risks of their forecast going forward, and they disclose what that is, and it's definitely skewed to the upside. He says it's true that raising the forecast in such a manner means there's a high bar to resume hikes, meaning that if they anticipate higher inflation, right, and higher growth, and they aren't raising into it right now, that's kind of suggests that they're comfortable with where rates are, even comfortable with a quarter-point increase. But one difference between June and today is the massive swing in how officials see the balance of risks weighted now to the upside in their PCE forecast. And this would be the PCE deflator, which is their favored inflation measure. The number of participants who saw the risk to their forecast weighted to the upside went from 3 in September to 15 today. Okay, so that really freaked out the market, the equity market, as well as the bond market, of course. At what meeting do officials move that risk assessment back to broadly balanced, and for what reason? And then he gives, the bar charts that emphasize the change in attitude. And here's my note. I more or less sympathize, though, with Warren Pies. He gives 2 paths for next year. With his path 1, and that is that actually weaker data is likely to emerge in the first part of next year. Now, and I'll talk about what the implications would be for the market. That said, part 2 does jibe with the latest data, and that would be policy next year pushes the economic read inflation needle further. My point's going to be neither being great setups for equities. So he talks to Nick Timiraos here and says, as to when the risks come back to normal, I see 2 potential paths. Data path, based on current data, there's a high likelihood that the risks come back into balance soon, March, via weaker labor market, housing data, and so forth. So he does say current data, and here I say current data says something else. This would be current, deeper, under the surface data that we're seeing in the jobs market. We're seeing it as well, and it does suggest that we are going to get some weakening next year. Or the future policy path, the new administration really juices the economy with tax cuts and more stimulus, then the bar could be higher for these officials to revert back. In other words, the reaction function has durably shifted in a hawkish direction, which would suggest higher, not lower interest rates going forward. For what it's worth, if the committee moves down path 2, it opens itself up to increased political criticism. So here's the point. This is worth closing on. So our own index actually moved to neutral, so it's the first time it hasn't been red in like 22 months. That said, and I've illustrated this before, we do tend to get kind of a blow-off top even in the data right before recession. A lot of under-the-surface leading indicators for the labor market, et cetera, are still saying we're not out of the woods, that the weakness next year is very much above a non-zero possibility. Now, weakness would be welcomed by the market, all things equal, if indeed the Fed reacted to it swiftly enough, and we're back to that soft landing scenario. If it really starts showing up rapidly in corporate earnings, which it tends to, if we get that recession, stock market's in big trouble because it is pricing nothing but forward earnings growth ad infinitum. A recession does not give you earnings growth; it gives you the opposite. And then again, if things continue to be strong, that was actually the signal yesterday, and you saw what the stock market did. So hence, my title to part 2 of our year-end letter, Goldilocks, is kind of caught between a rock and a hard spot. That is very, very much the case right here. Does not in any way mean that next year is going to be a horrible year. It means it's going to be a volatile, difficult year. And until fundamentals either rise to where valuations suggest they should be, or valuations decline to where fundamentals suggest they should be, or at least on the way there, until we get either of those two scenarios, we're going to continue to hedge, stay very diversified, and clients have you in a portfolio that's going to be confusing from time to time when you look at the day-to-day moves if all you're focusing is on the stock market. But hang in there. Right now, patience is key as we work our way through the latter phases of this cycle and onto what I think is going to be a very interesting and very opportunity-rich next cycle. We're just not there yet. Folks, thank you so much for watching and listening. Don't know if I'll need to do another one over the weekend. If not, hope you have a great weekend, and I'll be back at you next week. And if you didn't get a chance, by the way, to read parts 1 and 2 of the year-end letter, please be sure and do those, because part 3 is going to be coming relatively soon. Thanks again. Bye-bye.